When most people think about investing in real estate, they usually picture buying a rental property. You find the property, you arrange for financing, you collect rent, you maintain the building, and hopefully you build equity over time. And it's a model that most people obviously understand. But what if I told you there's another side of real estate investing that many Canadians have never been introduced to? And it's a way to participate in the development of apartment buildings and purpose-built rental communities without personally becoming a landlord. It's called private real estate development investing. And today, I'm going to explain how it works. And to make this concept even easier to understand, I'm going to use a real Ottawa development project as an example throughout this video. And this isn't investment advice, and this isn't a recommendation to invest in any particular project. Every investment has risks, every partnership is different, you know the drill, full disclaimer. My goal today is to simply help you to understand how this type of investment is structured, why projects like this are built, and some of the questions that I believe every investor should ask before considering an opportunity like this. And if you've ever wondered who actually finances the construction of new apartment buildings, I think you're going to find this video pretty fascinating. Let's get into it. And before we talk about investing, let's first talk about why these projects are being built in the first place. One of the biggest mistakes that investors make is focusing on the building before understanding the market. And professional developers usually start somewhere completely different. They ask one simple question: what problem are we trying to solve? And over the past several decades, the way Canadians live have changed dramatically. People are getting married later. More people are living alone. More couples are choosing not to have children. More students are renting longer. Young professionals are delaying homeownership. And many retirees are choosing to downsize. And the average household today looks very different than it did 30 and 40 years ago. Today, 1- and 2-person households represent the majority of households in Canada, while studio apartments remain a relatively small share of new rental construction. And in Ottawa, vacancy rates for studio apartments have also remained particularly tight because supply is limited. And that's important because great developments aren't created by asking, what do we want to build? They're created by asking, what type of housing does today's market actually need? Developers who understand demographic trends aren't just building apartments, they're solving housing problems. To make these ideas more practical, let's look at a real Ottawa development company and a specific Ottawa development project. Rather than thinking about this as an investment opportunity, I want you to think about it as a real-world example that helps explain the concepts that we're going to be discussing today. This particular development was designed as a purpose-built rental building here in Ottawa. It focuses on compact, efficient living, and it incorporates net zero construction, and it's located near public transit, employment, shopping, recreation, and other everyday amenities. It was also planned to proceed without requiring rezoning or minor variances, reducing certain development hurdles. So ask yourself, who is this project really being built for? Potentially a student attending university, a young professional starting their career, someone relocating to Ottawa, someone working nearby, someone who values convenience over extra square footage. And instead of trying to build housing for everyone, the developer identified a specific market need and designed the project around the people most likely to live there. That mindset is one of the first lessons I think every real estate investor should understand. Whether you're buying a single rental property or evaluating a larger development, understanding who your future resident is can be just as important as understanding the building itself. Because when a project aligns with real demand, it has a stronger foundation than one built simply because the land happened to be available. So now that we understand why projects like this get built, the next logical question is, how do investors actually participate? Because unlike buying a rental property, you're not purchasing a specific apartment or apartment unit or apartment condo or whatever. You're investing in a business that's building, financing, and operating an income-producing asset. It's really a business. That's where private real estate development investing starts to look very different from anything most people have ever seen before. So, if investors aren't buying an apartment, what exactly are they investing in? The simplest way to think about it is this. They're investing in a business of creating and operating a real estate asset. And instead of purchasing one condo like we had talked about, or one rental property, a group of investors come together to help finance the development of the entire project. Now, that doesn't mean that everyone is making construction decisions or choosing paint colors. Everyone has a different role. Most private development projects have two primary groups. The first is the general partner, often referred to as the GP. And think of the GP as the operating partner. And I've mentioned this in a recent video just a couple of weeks ago. They're responsible for finding the land, designing the project, working with the architects and the engineers, obtaining the permits, securing financing, managing construction, leasing the building, operating the property, and making thousands of decisions over the life of the project. In other words, they're responsible for executing the business plan. They are the boss. Then, number two, there's the limited partners or the LPs, and their roles are very different. Limited partners provide the capital to help make the project possible. They aren't managing the contractors, they are not collecting rent, and they aren't responding to maintenance calls. Their investment is in the partnership itself rather than direct ownership of an individual apartment or an individual building. It's much closer to being a business owner than being a landlord. And we're going to get to the case study very soon, but another question, or a question that I get all the time, is why would a developer invite other investors? And obviously it's a question we hear all the time. People often ask, if the project is so good, why doesn't the developer just do it alone? And it's a fair question, but the answer is that the real estate development is extremely capital intensive. Before construction even begins, the developers are paying for things like the land, the engineering, the architectural plans, environmental studies, consultants, municipal fees, financing costs, permits, legal work, and many other expenses. Construction financing typically doesn't cover every dollar required to bring the project to life. Private capital often helps bridge that gap. By bringing together a group of investors, the developer can complete projects that might otherwise require significantly more personal capital. The investors provide the capital. The developer provides the expertise, the experience, and the day-to-day execution. It's a partnership where each party contributes something a little bit different. Okay, so let's simplify what that journey typically looks like. First, the development opportunity is identified. Next, the project is designed and planned. Capital is raised from investors. Permits and approvals are obtained. Construction begins. Eventually, the building is completed. Residents move in. The property becomes operational, and professional management takes over the day-to-day operations. And at that point, what began as a development project has become an income-producing real estate asset. Our Ottawa case study follows a similar progression. The project is intended to move from permitting into construction, then lease up with permanent financing expected after completion and stabilization. Stabilization meaning rent and tenants. Now, here's the part that has really changed the way that I look at this type of investing. And please stick with me. This is really super cool. And interestingly, it has very little to do with projected returns, and it has everything to do with how capital can move through the life of the project. Most people assume that when you invest in real estate, your money simply stays invested until the property is eventually sold. That certainly happens with many investments, but some private development partnerships are structured differently. And that's where I became genuinely interested. Okay, so stick with me. We're getting to the juicy section, and I want to explain what many people refer to as the capital life cycle, because understanding when and how capital may be returned helped me to appreciate why some investors include private real estate developments as one part of their overall diversified portfolio. And just remember that every partnership is different. The timing of financing, the distributions, the return of capital, and the eventual sale all depend on the specific legal agreements, the financing arrangements, and how the project performs. And that's why it's essential to review the offering documents for any opportunity rather than assuming that all projects follow the same path. All right, so the capital life cycle, finally, this is the part that I really want you to understand. And understanding this concept was the moment that everything clicked for me personally. I actually remember sitting with the developer at my kitchen table at the time, learning about this. And that, if I'm being honest, is what prompted me to get my exempt license to be able to actually participate in these types of investments. So here's the basic idea. When investors participate in a private real estate development, they actually invest their capital and it helps bring the projects to life. We've already talked about that. It supports absolutely everything. And once the construction is complete and the tenants move in and the building begins operating successfully, many projects transition from a construction financing to a long-term or permanent financing. And that transition is an important milestone because depending on how the partnership is structured, a portion of the investor's original capital may be returned at that stage. Again, a portion of the investor's capital is returned at that stage. So this is really important. And return of capital is really different than investment income. And the return of capital simply means that the partnership is returning some of the money that you originally invested. And it's not necessarily a profit, it's your own capital coming back to you. So here's the part that really changed everything. Again, if you're receiving part of your original investment back to you, you're now available or allowed or you're freed up to do whatever you want with that capital, while the ownership interest in the original project continues under the terms of the partnership. So think about that for a second. Instead of waiting until the very end of the investment before your capital becomes available again, some partnership structures may allow your capital to begin working in a second opportunity while the original project continues to mature. And that idea has fascinated me. And that part fascinated me not because it guarantees a better outcome and not because it's risk-free, but because it introduced me to a completely different way of thinking about capital itself. Rather than seeing capital as something that's being locked away for years, I began thinking about how capital can be recycled over time. As additional return of capital occurs, if the partnership agreement provides for it, the amount of the original investment still at risk will decline over time. And eventually, if the project performs as planned, and if the partnership is structured in this specific way, an investor's original capital may be fully returned. And from that point forward, future distributions may be represented as income rather than return of capital until the property is ultimately sold according to the partnership agreement. So let's unpack that. You invest, let's say, $100,000. You get a significant portion of that back once the permanent financing is triggered. In some cases, it's 50%. In some cases, it's 2/3 or 75%. At that moment in time, let's say you receive 2/3 of your invested capital back. Then could be a couple of years, could be 5 years, could be 10 years. You're still receiving return of capital until the full amount that you initially invested is paid back. That's your return of capital. So your return of capital is now paid for. It now transitions into income, investment income. You have to declare your returns at that point once your return of capital has all been received or received back. It now transitions into investment income. Yes, you declare it for Revenue Canada. That's okay. You now have investment income, and you'll ride that investment income for however long you want or however long the GP wants to run this specific investment. Eventually, the building is sold. And once it's sold, you now have your proportionate amount of the appreciated value of that specific project. And yes, again, you go back to Revenue Canada and you declare your capital gains from your specific investment. But the important thing to highlight here is investment in portion of that money comes right back to you, reducing the risks. You get all of your return of capital until eventually all of it is paid back. And then at that point, it transitions into investment income. You ride that for as long as you want to ride that. Eventually, the building is sold and you declare capital gains. That's the capital flow that we were just talking about. Brilliant when you think about it, because now you're moving your capital once you've received 50%, 2/3 back, 75%, whatever that amount is. You do whatever you want with it. Move it over to the next project, move it over to the next project, and keep compounding your cash. There you go, ladies and gentlemen. I hope that this video was helpful. As promised, the builder or the case study that I had highlighted at the beginning of this video is Shepherd Development. They're building micro units here in Ottawa. They have many projects on the go. And whether or not you agree with micro units being tiny little units that serve a purpose and they target specific people, whether you would personally live there or not is kind of irrelevant. It's understanding the investment underneath Shepherd's projects. And if you want to learn more about Shepherd Development or potentially even invest in some of their projects, reach out to me. Obviously, through my exempt market dealing license, I can help you through that. I can send you the pro formas. I can talk you through the planning of it all. I can introduce you to the developer and we can talk shop about anything from a construction basis. So again, pretty exciting opportunities. And it's an example of investing in different ways than your traditional buy a unit, sit on it for a while, and hope for the best. If this is interesting to you, reach out to me. My contact details are below. I look forward to discussing it with you in more detail. And as usual, I look forward to putting these videos together on a weekly basis. So until the next video, stay smart, stay invested, and I'll see you in the next opportunity.